Hello and welcome to Quartic Training. Study session 18, Portfolio Management. This is the very last study session in the curriculum for Level 2. We've got 5 chapters of very different sizes. First of all, Portfolio Concepts. This is the biggest chapter, one of the biggest chapters in the whole of Level 2. It's actually 100 pages long in the curriculum, so very, very large. Very likely for a question. Lots of mathematical connections between the different attributes of different investments and what happens when we put them into a portfolio and how we can use those portfolios to achieve different objectives. 61, just a very brief comment on CAPM, something from Harry Markowitz. 62 is the other big chapter, which is also very likely. This is pretty complex. It's not that long, but it's complex, and it links into your previous studies in economics as to what are the risks and rewards of investing in overseas assets. 63, again fairly short, this one. So here we look at the Trainer-Black model, which is a little bit complex. And then finally 64, a recap of what you started doing at level 1, which is the portfolio management process and the investment policy statement. Portfolio management overall is 5 to 15%, so slightly bigger than quants and economics. And 5 to 15 means probably 2 questions. So historically this has been around 2 questions. You will almost certainly get something on portfolio concepts, because there are so many parts of that chapter that are examinable, that make good questions. Quite likely get something on international investing, though that could be conjoined with something in other topics like economics. And you'll probably have reference somewhere to the investment policy statement and specific investors and how we need to invest on in order to comply with their IPS. So those are the 3 chapters that I would certainly expect. Trainer-Black might pop its head into a question, but less likely. And 61, I suppose it could get a mention, but it is much smaller. That's the outline. Reading 60, Portfolio Concepts. Technical, mathematical, quite detailed. We start off with a review of what we've seen at level 1, mean variance analysis, looking at expected return and standard deviation, so return and risk, when we look at 2 asset portfolios, which we certainly covered at level 1, and we extend it to 3 asset portfolios. If you can remember from last year, the Quartic covariance matrix, then the 3 asset calculation is not too complex. Minimum variance and if Markowitz efficient frontiers, we saw those at level 1. Diversification benefits and correlations. Equally weighted portfolio, there are certain bits of, a couple of equations we need in that relating to larger portfolios made up of equal weights of a number of stocks. Capital allocation line and capital market line, we saw that at level 1, as we did CAPM, it's assumptions and predictions. SML we've seen as well, beta, market risk premium, Sharpe ratio, so a lot of this revision of level 1 concepts, but in all cases taking it some serious steps further. The market model is a specific way of describing how the expected return, or how an asset return could be predicted, and we'll see 3 equations there. Adjusted beta, if we have a beta, what is it likely to do over time? And a comment on instability in the minimum variance frontier. We then look at multi-factor models, a very clear link to a quantitative approach, so obvious type of place where we can get quantitative techniques in a portfolio question, or portfolio techniques in a quantitative question. We look at factor models, 3 types of factor models. The arbitrage pricing model, how that compares and contrasts with CAPM. A couple of definitions on active risk and return, tracking error, information ratio, and so on. Factor and tracking portfolios can be a bit complex, but I'll show you some simple examples of those. And then, to conclude, a comparison of CAPM and arbitrage pricing. Let us begin with mean variance analysis. Just to set the scene, we saw at level 1 that the basic theory behind portfolio management is that of risk and return. We want to maximize return, minimize risk. We know that we can't do that in all cases. We're going to be looking at the link between risk and return. And when we were studying level 1 portfolio, we specified that one of the most common definitions of risk was standard deviation, and we continue along those lines for the moment. So standard deviation, as we know, that is giving us a variability in the level of returns. It's not necessarily the most appropriate measure to use for risk, however it will do. So the theory we're looking at initially is all the modern portfolio theory of Harry Markowitz and we'll be looking at those assumptions and how the model fits together. We are trying to identify the best risk-return payoff. We want to maximize return and minimize risk. The way we need to do this is to look at how risk interacts. If we combine multiple assets, then the return is a simple weighted average of the returns of the individual components, but the risk is going to be usually reduced a long way below the weighted average. And the reason it is reduced is because correlations between asset pairs are less than 1. Covariances are often less than variances, and therefore we do have this benefit. The computation of an optimal portfolio can be pretty complex, and we'll look at this a little bit, but we're not going to be doing calculations of how we get to an optimal portfolio. Lots of assumptions here. Investors are risk averse. Remember this from level 1. All investors, given 2 options of the same return, would go for the lower risk. Given 2 options of the same risk, would go for the higher return. This is called a rational investor. And even though some investors may not mind risk so much, everybody would still rather avoid it. So you've got 2 extremes, I suppose. One is a very, very risk-averse investor. For instance, someone who is in their retirement and has only just enough to survive on a subsistence level. They cannot afford to have any variability in their income. So they would generally go for a very low return, low risk portfolio. If you remember, that would be down the bottom of the efficient frontier, the Markovitz efficient frontier. More of that later. On the other extreme, you may have a much less risk-averse investor. Not a risk seeker, because a textbook investor is never going to be a risk seeker, but someone who, let's say, is earning significantly more than they're spending, is young and has a very long time horizon until, let's say, their retirement, and can afford to take on much more risk in return for slightly more reward, in the knowledge that over, let's say, a 30 or 40-year time horizon, the chances are almost certain the additional reward will outweigh the additional risk we've taken on. So 2 extremes there, but in all cases we are to some extent risk averse. We also assume we know everything about each investment. So we know the expected returns, we know probability distribution if appropriate, and we know all the variances of assets, and we also know the covariances of all pairs of assets. So we know everything about the return distribution. That's important, because otherwise we can't do any of the calculations. And it's only using the mean variance framework that enables us to identify the optimal portfolio. That's it. We're using the numbers and probability distributions and correlations and so on. We ignore taxes and transactions. Let's begin by recapping a 2-asset portfolio. The expected return is a simple weighted average, so ERP. We've got 2 assets, 1 and 2. The weighting of 1 and the weighting of 2, W1 and W2, add up to 1. And the expected return could come from a probability distribution. And the expected return is just the weighted average, as already said. The standard deviation, I will explain this in a few moments, but the standard deviation is the square root of a weighted average covariance. So let's just do some number plugging first of all, and then I will try and make this equation make complete sense. Yes, you do need it, and a bigger version of it. However, it will be something that hopefully you can write down intuitively. So what we've got here, the portfolio variance is W1 squared sigma 1 squared, so the weighting squared of asset 1 and the variance of 1. W2 squared sigma 2 squared, weighting of 2 squared times variance of 2, and then 2 W1 W2 times the covariance, or 2 W1 W2 rho sigma sigma. And that's, if you like, a bit of both. So you've got a bit of weighting of one, weighting of the other, and the covariance. And then the standard deviation is the square root of all of that. So let's have a go at this. You're given a 2-asset portfolio. 70% is invested in asset A. Expected return 12%. Standard deviation is given. 30% in B as given, and a covariance of minus 1.710. Compute the expected return and standard deviation. Let's have a go at this.